What's up, guys? It is Tuesday, August 18th. And interesting background here with us today because we're getting deep in some stuff. So let me give you a little bit of story behind this one. It was a little over a year ago. I was in Alaska bear hunting. So I'd been the year before, successful hunt. First time I've been to Alaska, we did not know what I was going to get into and end up being one of the greatest experiences of my life. Second year, and you guys can go to my website, aaron.chapman.com, go into Where's Aaron up in the upper right-hand corner, click on that, and you can drop down. There's only 3 stories there. I should be putting more out there. Marketing guys are busting my balls about it. If you go to the bottom one, you see a boat there at a dock there in Alaska. It tells this story. So ultimately, I was going the second year. Of course, I thought I knew what to expect the second year, and I'm sitting on the plane with my buddy Keith, and we're prepping to take off, and then I get a call from Joel. And Joel's one of the other guys I go hunting with. And I picked up the phone, and here's Joel. He's like, dude, where are you at? It's like, I'm on the plane, getting ready to take off. He goes, we may not be hunting. I was like, what do you mean? He says, our guide just got shut down. He got boarded by the Fish and Game. He's missing 1 jerk-off permit, which, being able to go from high tide to low tide and exiting onto shore, which they need a permit because tides to get off the boat. Absolutely crazy. The amount of permits this guy has to get is insane. And since he didn't have that, now they've shut him down for the rest of the year. And that literally happened that morning. So I'm like, dude, I didn't know what to expect last year. Now I don't know what to expect this year. I'm going forward. So we took off. We went and we were just riddled with problems. Man, I damn near drowned on the third day, I think it was. Got dumped off the boat on the dock, trying to stop us from coming in. I was fully geared up and went down 15 feet. Rubber boots, kicked off the bottom of the ocean floor, swam up, got my hand onto on the dock. 2 guys yanked me out my right arm a little while ago because of shoulder surgery. That exacerbated damage. That's full of conversation. But last night that we're out there hunting, I'm with this guy Blake, one of the guys hunting with us. The other 3 guys are out. One's really sick. The other 2 guys blew up a motor on a boat. Just problem after problem after problem. We go out and we're all day long, and I see a bear from across the islands on the other. So this is Edelin Island right here. And that way, way over there is Wrangell Island on the other side. We're over by Wrangell, and I'm watching the shore of Edelin. I saw black movement. And closer and closer. There's a big old bear out there in one of the coves. So we pulled into this cove right here. And right over here, we anchored this boat back out here. That was shore at the time. And I pulled the anchor way up here onto shore, and I drug the boat all the way to the shore, put the anchor up on shore, and put a massive rock on it, and we took off. Well, didn't get that bear. Well, we hiked back an hour and a half later, and that's where the boat is. And that's not a small boat. It was a pretty good-sized boat. So I looked at Blake. I'm like, okay, dude, person who loses goes. He's like, 1 round or 2 or 3. I was like, 1 round. We did rock. We both did paper. I went back. I went forward on the scissors, and he changed it up, and he won. So I went wading into the deep stuff. And I don't know if you know what Alaska's like in I think it's March, if I remember correctly. It ain't warm water. Stuff's cold. And that was the second time I went swimming on that damn trip. And I got out there, and when I finally got to that boat, and I swam out there, I'm trying to pull myself in. I'm shaking like crazy because I'm so cold. I get in there. I turn on the boat. Depth finder shows 14 feet. That's sitting on where the anchor was. The anchor was 20 some odd feet up on shore with a rock on it. It was floating above the anchor, and it was 14 feet. Well, it was down 3-4 feet on the shore. So nearly 20 feet came in, something like that. So it was something. The tides out there are crazy. So what we're doing today, the reason I brought this up, we got Mr. Dave Bennett on here. So I'm going to tell you his title. I'm not going to tell you what he's about. I'm going to let him get into that kind of stuff because this is the guy I rely on for a lot. And we've been talking a lot about rates. We're going to talk a lot about what's going on. We're going to get deep into the rates, into the really cold, nut-shrilling discussion about rates. So, Dave, thank you for coming on, brother. Thank you for letting me spout for a minute. I appreciate you taking the time. So tell us, what is your role at Security National Mortgage Company?
Well, thanks for having me, Aaron. My official title is I am the Vice President of Market Execution. And what that means is I'm in charge for a number of the back-end operations, starting with funding, warehouse relationships, post-closing, shipping, insuring, a lot of that back-end stuff to make sure that the loans that we fund get purchased. And then also secondary marketing, which gets a majority of my attention and is one of the probably more popular subject in a forum like this to talk about the market and what's going on with rates and what the challenges are.
Very cool. And so the reason I definitely wanted to have you on here, I have a certain amount of understanding, and I've tried to give as much as I can to the folks who are watching here, enough to understand when they hear mortgage-backed securities, or they hear that the Fed just lowered the rate, or the treasuries are up, that they need to understand that it doesn't correlate precisely the way the rest of the world makes it sound like. You know, I came to a conclusion about that very early in my career when there was this guy Jaime at our that they found rates going up. Like, just tell me, hey, hold out or whatever. And now you got outfits out there that are willing to share that data with us, but they're sharing it with people who are industry, at least professional, not sharing with the public. So my goal is to share with the real estate investors what they're not going to get from anybody, which is what they should be looking at, why they're looking at it, what drives it, and a little bit of that background. And then we're going to get really deep into it on another episode here. That today we're going to hit the surface. We're going to dig deep into the background here. So what I'll do here first is when a person is locking a rate, and you get a rate, let's say a real estate investor, 20% down, 30-year fix, nothing sexy, vanilla kind of thing, and I'm pulling up rates that day, I'm going to pull up a wide range. You know, you're going to start like 2.25 all the way to say 4.125. You're going to see it from par all the way down to 5 points. Where does that all come from?
Yeah, well, it's the starting point is the mortgage-backed security market, and basically what happens is in order to increase liquidity in the market, pool together to create a security. And for the end investor, that obviously helps spread out the risk from a borrower perspective, from a state perspective, from a rate perspective. And so those mortgage-backed securities are incredibly liquid assets. I mean, they're very standard in the market, and it's easy to buy and sell those. And so by those mortgages going into mortgage-backed securities, it creates a lot of liquidity for the mortgage market, and that's kind of the starting point for what the price is going to be on an individual rate. It's going to look at, well, what's the price for that end security that the investor wants to invest in, and
when you're saying the investor wants to invest, and you're talking about the people putting their money into those bond pools and expecting a rate of return on investing their money. And when you say liquidity, you're saying that is the mortgage market, the people lending out there, now they have capital to lend. That's where that liquidity is. It's liquid
Correct.
Capital to be able to release out into the market and fund loans with, correct? Because when we're talking to real estate investors, they think what the investor wants is like, oh, the real estate investor buying the house. No. We're talking about the investors putting the money up into the mortgage pools that we get to pull from to be able to lend out.
Yep, exactly. And so, you know, every week there are auctions that go on with mortgage-backed securities, and we get to test what the investor demand is for that security, and that then drives the beginning part of what makes rates. Now, there's a lot of other things that go into that. So if we take, for instance, a mortgage-backed security at a 2.5 coupon, well, that 2.5 means that the end investor, his yield on that security is going to be 2.5. Well, that's going
to be his return on investment, correct? I'm going to pull up the 2.5 coupon right here.
Yeah, but the mortgages that are inside of that security, that make up that security, there's a whole host of different rates. Generally, it would be from anywhere from 2.75 to 3.5, and the reason it's higher is because the servicer or kind of a middleman in the process of creating that security is going to skim off some of the yield on that mortgage that's at 3%, and so it leaves 2.5% for the end investor. And so that's why it's a 2.5 coupon, although the mortgage rate is going to be 3% or even up to 3.5%.
Yeah, and a lot of folks will be like, man, where can I find somebody with lower margins? Like, guys, we got to keep these organizations alive. You got to think about this. It's so frustrating. People are like, well, why don't you find somebody to give me the cheapest deal? I get it. You want to get the best pricing, But when you're going out there to people that are trying to really cut the margins low, you're talking about trying to find the lowest risk deal, what's perceived the lowest risk deal with the least amount of effort getting involved. So your real estate investors aren't going to get that. That's your internet mortgage companies that don't understand the real estate investor. They're not going to be there to help to make sure you have a 30-year fixed loan to buy your properties and pay it back with a diminishing instrument like the dollar. So think about that stuff when you're considering. It's like, well, hey, find the whole margin thing. If it frustrates you, they need that to stay alive. If we don't have these companies, what do you have?
Yeah.
So thank you for putting that out on that
Yeah,
margin.
and there's a lot of people in the process that need some margin to stay alive. You know, it's not only Security National. We obviously have our margin, but it's whoever it's Fannie or Freddie that pools these loans. It's whoever the servicer is. They need some margin to, you know, pay for their servicing operation. So there's a lot that goes into it.
Well, and there's also, I mean, this is also literally a trade, right? This is a Wall Street trade. When you close a transaction, somebody's trading money out there, correct?
Correct. Yeah.
So you're talking, there's people out there throwing hand signals at each other to get that mortgage moved. So somebody's going to buy that. There's a margin in there too. So there's margin all the way from where they drop that money into that pool to the people who gather that money up, who basically have to tally up what's what, have to try to run the at least all the systems in place to track whose money is where. I mean, there's a lot going in there when you've got somebody's pension over there in middle America put their money into this pool, and it trickles all the way down to a guy out in Northern California who bought 5 houses down in Alabama. You know, that there's a lot of tracking going on in that when you think about that. And then there's those guys over there throwing each other hand signals and the finger and whatever else, trying to get the money moving around. There's a lot of people got to get paid. And then on top of that, we got regulation. We got people doing auditing. We got to pay for that. I know the auditing costs have got to be significant. What, a couple $1,000s a transaction?
Absolutely. Yeah. They've risen dramatically in the last decade. Compared to where they were previously with the Dodd-Frank Act obviously added a lot to it and compliance and there are pros and cons. Yeah, absolutely. There's pros and cons to that legislation, but it does make mortgages more expensive for the borrower.
It is what I'm trying to explain to a lot of folks to try and help them really, really wrap their head around it is, it used to be me and an assistant back when I was I was a player kicking ass in the countrywide days, right? And we can get away with a lot of stuff back then because there wasn't as much legislation as far as how sloppy you could be with the paperwork. Not so much could you be really sloppy with the loan because you'll end up in prison, right? But as far as the paperwork, we weren't so concise with sending out disclosures and all those kind of things as often as you needed to and all those things. Well, now I got a staff of 26. I'm hiring a 27th. For me to be able to do what I do. And it's because the manufacturing process is so stinking expensive. And it's not just, hey, this person wants a loan and here's this paperwork, let's get it underwritten, let's get it closed. It's, we got to send this document at this time. We got to make sure that this is buttoned up in this particular thing. We got to run this system over and make sure we're not violating this rule. Got lower income housing regulations because people are buying in places where everything's $70,000 or less. There's so much that we have to be cognizant of, because if we're not, then we're going to have black SUVs filling up every parking space in my parking lot. And I don't need that.
No one wants that.
No, heck no. So talk to us about, what's happening here with we got the forbearance situation that people are still, concerned about. We also have, what Fannie and Freddie just came out through, we had that release from the FHFA. I'm really kind of curious your thoughts on that. I've got my thoughts. And I've got, I'm sure you've got a few, but let's go back to the forbearance discussion, because you and I talked about that in the past. What are we seeing as far as Security National is concerned?
The forbearance issue is impacting all lenders, and we have a servicing portfolio that's about $3.5 billion, and so we have a number of borrowers in forbearance. Our percentage is just over 5%, which is a little bit lower than the national average, which we feel good about. Though a big part of that reason is because we don't retain any of our government servicing, which we are very thankful of in this market, because the forbearance issues on the government servicing is a lot greater.
So you're talking government servicing, we're talking FHA, VA, and USDA, right?
Correct. Correct.
Any other? Those are the only ones, right?
Yep, those are the three, and the forbearance rates on those three is about double what it is on the conventional side. So
And
yeah,
why do we? Okay, let's talk about that for a second. Why do you think that is? Because I have been painted as the real estate investment guy, right? I got painted very early on as like, "Whoa, you're the high risk guy." But
yep,
now we're seeing when the market gets shaky where the risks are. And
yep,
any thoughts there, or can we even step in that? Is that sacred ground on a compliance
yeah.
level?
I mean, it's I mean the borrower, the type of borrowers that go into FHA loans are riskier borrowers. If you have a 640 FICO and you want to do a conventional loan, you're going to pay an extra 200 basis points because of your FICO score. Well, you go over to the government
The
side,
risk-based pricing, right?
right? Risk-based pricing. On the government side, you don't pay that premium. Certain lenders may put in their own premium for low FICOs, but as a general rule, Ginnie Mae does not charge, or FHA does not charge a premium for low FICO. And they also allow low down payments. On VA, you can get in with 0% down. On FHA, it's only 3.5%.
Mm-hmm.
And so you're getting riskier loans in that product, and it bears out in the servicing performance.
Well, the other thing that we have found with folks is we went through that cycle of people that, I mean, there's definitely some time in the history of the United States where you hell or high water, you pay your mortgage, right?
Yeah.
Well, now we see what it's like for an entire generation of people to lose homes, right? And then we get to the point where not only was it losing your home, but there was the embarrassment of having the sheriff's department come up and exit you out of your home, right? And people saw that, they witnessed that. So now it's like, well, something, some people were really cautious about, I don't know that I want to buy a house because of the hell that we went through, or what I saw the neighbor go through. And then on top of that, it's like those who did go through, it's like, that 7 years wasn't so bad where we had to rent. So if we put little down, we're not risking anything, right? So there's very, very little risk on their side. And I'm not trying to paint people a certain way. I'm just saying this is human nature. We rationalize things. It's every single stupid thing I've done in my life. I talk myself into it over time. It's not something I decided one day I'm gonna go do something dumb as hell. It's like, wait a minute, I think I can get away with this way and this way. And I literally mapped out a plan to do something really, really stupid. And now I've learned from all the crap that I've done in my world to, hey, I just stay here. The trail's this wide, I stay on the trail because every time I step up, I fall and I get hurt and it sucks. So that's kind of where I was hoping that you would get into, and I appreciate you getting into that because I find it interesting that the real estate investors, when we're looking at the portfolio of loans that we're servicing on the conventional side for my investors, we got very few, a small handful, I think, is in the 30s, like 32 or 33 people that were in forbearance, and not all of them were even late. They were just doing the preemptive thing because they were worried.
Right.
Look at actual delinquencies, the rate of delinquency in my portfolio. I got like one person who's got a 30-day late. So it's exciting to me. It took me 5 years to get here to see the data, but the data is there and it's awesome.
Yeah, absolutely. You should take a lot of pride in that, and your investors should feel really confident in you based on that performance, because that's incredibly better than our average and the industry averages. So well done.
Well, thank you. And I think it boils down to understanding what the real estate investor is after and being able to help them get there, because that's the goal. This is why we're even doing this conversation, is to help them understand, what are you getting into? Why are you getting into it? You need to determine that for yourself. And then what are you going to do when things get shaken up? If you have properly structured your business, because this is what it is, a business, you can handle that. So there's the thing right now with the FHFA, right? And that is the Federal Housing Finance Administration.
That's correct. They're kind of the watchdog over both Fannie Mae and Freddie Mac. So
Fannie Mae and Freddie Mac are in conservatorship. Define that for folks.
Well, it basically means that they're government-owned entities at this point, and so the government, when they bailed them out back in the crash in the early 2010 area, they loaned a lot of money to Fannie and Freddie. And ever since then, Fannie and Freddie has paid back everything that they borrowed and more. In fact, all their profit is being swiped by the government. And so it's been a nice little piggy bank for our political friends. But FHFA came in last week after hours on Thursday and announced that they were adding a 50 basis point charge for all refinances that Fannie and Freddie are going to purchase starting September 1st. And what that basically means is that there's a process, obviously, to get the loan from funding to purchase by the agency. And so because of the time frame they gave us, it basically meant that our entire locked pipeline is now subject to a 50 basis point charge that we didn't know about when we originated those loans. It's basically a tax that FHFA is putting on all lenders. That's the short-term impact. For a company of our size, it'll probably cost us between $1 million and $1.5 million. For a company like, Quicken or, that's going to be in the tens of millions of dollars or more. And it's just a tax on lenders that there's no way around. And then beyond that, the long-term effect is it just raises costs for borrowers, which is just, it's crazy to do in this time where we're trying to recover from, the economic struggles of COVID-19. And one of the few bright spots in all of this has been housing and real estate. And to come in and raise money, raise prices for all these borrowers, it's going to cost them on average an extra $1,400 to close a loan. And it's dirty dealing. It's really frustrating.
Well, okay. So if you need to add something to it, you got to add something. But then just overnight, the next morning, say, guess what, guys? Now you're hosed. You got to pay this, guys. That's some bad stuff. That's people knocking on your door and putting a gun to your face. Say, hey, give me what's in your pocket in a way. But a lot of it. And so what that means, everybody, is that's not necessarily a 50 basis point. We're just going to add that to your fees. That's going into the pricing model, right? So if we go back into, let's say, I'm going to show the 2.0 for the last 30 days. So we're going to get into this coupon because this is the one I've seen the most effect with that. So because these larger loan amounts, those are usually your people refinancing their primary residences. I've seen a massive swing pretty quickly. So that would be right here. August 13th is when that happened, right?
Right.
Or is it? I can't remember. Was it 12th?
Let's see. Thursday was what day was that?
Thursday was the 13th. So
yes, there we go.
Which, why am I not seeing more than that? So this is the 13th.
What you're looking at is just the mortgage-backed security price. Yeah. So again, that 50 basis point charge does not change the mortgage-backed security. It's just added on top of that and will be added into the final rate that the borrower sees.
So to be able to kind of illustrate that swing, that the difference in that, it would be probably, so right here, this particular swing right here, this is right around a 50 basis point swing this day right here, August 3rd. Saw about a 50, but yeah, that's right around 50 basis point swing. It's actually only 40.
Pretty close.
So if you're looking at that much movement, it's as if that day, when they came out, the next day, it's as if we lost this much. That whole candlestick, the wick stick, everything would have moved. So instead of here, it would probably have been a right down in here where my cursor is. So that would show how big of a swing that they would have dealt with as a result of that new pricing that's added in. Now, the most folks, they're thinking, okay, Aaron, I need you to lock before September 1st. I'm like, guys, it's a delivery date. There's no way that we can actually fund the loan, lock it, process it, fund it, deliver it, and have them log it, receive it, and do all that they've got to do within that time frame to be able to avoid this. It's unavoidable. The way they release that, everybody's getting hit with it. Period.
Right. Yep. Yeah, it's frustrating. I know the MBA and other trade groups have been pretty aggressive in pushing back, and I've seen comments from a number of congressmen. I think even the Trump administration has expressed their disappointment. So I know there's some people that think that there's a chance that FHFA would remove it or perhaps delay it. We can only hope, but if they don't, it's a big tax on the lenders and eventually just an increased cost to the borrowers, raising their rates by, that 50 basis points in price raises their rates by anywhere from 1/8 to 3/8 in rate.
Yeah, it could be that much of a swing, or you have to bring in a few more bucks to closing if you want to keep that rate lower. So, and I've been trying to devil's advocate this thing a little bit, right? So one, then you've got, when you think about the federal laws that we got to deal with, on our side of it, they keep this thing going for a month. They're like, okay, we're going to take it back. Well, guess what? Now you got all the disparate treatment and all the other things of the people that did get charged. And now everybody else is not getting charged. And now it's unfair. Now we got that whole mess on our hands. Yep. So man, it compounds out of control. But then I got to thinking, okay, so there's been talk, because I was in Washington a year and 3 months ago. I think it was something like that, meeting with different senators and Congress folk about the lending piece, right? And understanding what their perspective was on it. There was talk of disbanding Fannie and Freddie. There was talk about pulling them apart. I'm like, well, you do that, we lose 30-year fixed, right? To me, that's the holy grail for real estate investors, having that ability to leverage high, leverage long, and pay off slow to build your business. So my thought here, this is me devil's advocating this whole thing, is if they're going to tax an extra half, right? Is that something that's going to help fill the coffers for Fannie and Freddie, so when they do spin off and come out of conservatorship, that they have more capital available to them? That way they can start getting things rocking and they still exist and we can still get 30-year fixes? Oh,
absolutely. Yeah. I mean, I don't know about, I think Director Calabria's goal all along has been to, get Freddie and Fannie out of the government conservatorship and back into the private market. And this is definitely a move that would improve their capital position for doing that. Whether or not they would still be able to offer 30-year fixed mortgages, I don't know. That I think is still hard, just if you're only relying on private capital. So we'll see where that goes. But it certainly is a big windfall for Fannie and Freddie, which when you look at their recent quarterly earnings, it doesn't seem like they need that, but Director Calabria disagrees.
Well, come on, they're a government entity. Do any of them need that? When you get into what they need to collect on the next tax round, right? And that's an interesting statement you said. It doesn't necessarily mean they're going to have 30-year fixed because of private capital, but they sustain 30-year fixed with private capital for a very long time. I don't know how long they've been around doing the 30-year fixed. I haven't done that research, but they've been sustaining that for quite some time.
Well, they were, even before they were officially in conservatorship, there was kind of an implicit guarantee from the government that helped support that 30-year product. And so when you remove that, if you tried to remove that completely, that could put 30-year fixed at risk.
Yeah. I mean, and that's, I think people need to just have their eyes open to that. And that's right.
Again, I'm not saying I think that would happen. I'm just, it's just, we'll have to see where it goes. It's there's a lot of unanswered questions about what the housing market would look like if Fannie and Freddie move out of conservatorship.
Oh, most definitely. And hopefully, if this is what the move is, it puts them in a position to continue to offer that. Because as I'm telling my investors, while we have it, get it. Because that to me is the greatest, basically the greatest asset in your portfolio is a 30-year fixed loan against a appreciating asset that you can continue to raise rents on. So I can't see any better way to go about financing your investments. And just the fact that there's risk of it going away means you need to take advantage of it while we have it.
Absolutely.
Well, we're gonna get a lot of questions coming here because there's a lot more I want to get into, but we're already getting into 45 minutes into this thing, and I wanted to be sure that, well, I want to introduce you, and two, we're gonna get into the depth of what happens in the market when you lock the rate, and what happens in the background when we're trading it, what we have to do on the lender side to lock it for the length of time, because we still have to deliver that loan. Once that money's locked, it's locked. Somebody's got to pay on that. We're not charging you. What are we doing? And what happens when rates go down, right? Or what happens when they go up and you have a locked period? Now they're swinging around. Some people ask me, why don't you have a float down? I'm like, guys, you realize what the risk is here when we lock that in? And then we're talking about locking it in during a property being still under rehab, and the rehab takes longer. And now we got to extend that rate. There's a lot going on there that Dave and I are going to get into on our next time around. So get the questions out, email me some stuff. We definitely want to have your feedback. And Dave, thank you for taking the time away from your day. Any final words you want to throw out there?
No, I appreciate it. I'm, just grateful for the opportunity to be on the call, and really impressed with you, Aaron, and your dedication to your craft, the expertise you've gained and developed over your time. You're a true professional and a great asset for Security National. I'm proud to be associated with you.
Thanks, brother. I appreciate you saying that. And one of the ways I've been able to like you said, hone my crafts, because guys like you, people willing to open up the books and talk about it. Too often, departments within organizations like to keep their part secret. It's like, well, if we don't tell them, we can do whatever we want. That's not happened here. Now, I'll openly admit there may have been some sort of thing in the first little bit when we were getting to know each other. It's like, who is this redneck son of a bitch, and do we really want to tell him these things? But between yourself and Steve Johnson and Scott Quist and Joel and Joel Harward and Paul Christensen, the guys who just, then you guys embraced me and took care of me these last couple of years. Thank you. I appreciate you. And then you're giving me time here to help our clients. Just, I want everybody to know, you got, don't just have Aaron Chapman. You got my team of 26, soon to be 27. You've got executives like Dave and the other names I just gave you. That it's a lot of horsepower to back you guys up, fight for you to ensure that we have something to help our investors. So thanks, man. I appreciate you backing me up.
Absolutely. Thanks, Aaron.